Good morning. Welcome to ANZ News. It's the first day into the month of October. Thursday, the 1st. Today we're talking the monstrous numbers portend the global unwinding. If you're paying attention to any of the news coming out from the US and the UK yesterday, you probably would have seen those pretty big negative prints for GDP. So today we're talking about these monstrous numbers. Earlier this week, we shared Crescat's research into why structural changes in debt markets and intervention meant the reckoning is upon us. Today we feel compelled to share some quantification behind this phenomenon. Doug Noland has been mapping his credit supercycle in his weekly Credit Bubble Bulletin. Whilst not exactly an easy read, any investor needs to take the time to digest his latest piece, of which we provide key excerpts below. To set the scene, this is his conclusion. The unfolding global de-risking or de-leveraging episode only heightens US market fragility. With US elections now about 40 days away, the backdrop is set for extreme instability. The degree of speculative excess experienced over recent months would typically ensure vulnerability to a disorderly downside reversal and market dislocation. These times are, of course, anything but typical. It's an incredibly worrying backdrop, to say the least. The Q2 report represented by far the most troubling data I've encountered in my 20 years of chronicling quarterly Z1 data. These are the words of a level-headed data-driven analyst. Take the time to comprehend the unprecedented numbers that we talk about next. The talking heads and miracle vaccine hopefuls think this can all end nicely. But this is beyond a virus. This is structural and appears incredibly bullish for gold and silver, and most likely Bitcoin too. The numbers are just monstrous. The Fed's own data illuminate the historic monetary disorder that today runs wild. The Federal Reserve's balance sheet, treasuries, debt and equity securities, the banking system, the household balance sheet, rest of world holdings. In short, finance has completely run amok, with the data corroborating the supercycle endgame thesis. Total non-financial debt, or NFD, increased to $3.552 trillion during Q2, more than doubling Q1's record of 1.449 TN, or trillion gain. This pushed first half NFD growth to an incredible 4.71 trillion. For perspective, NFD expanded to 2.439 trillion in 2019 and averaged 1.826 trillion annually over the last decade. Q2 growth actually surpassed 2004's annual growth record of 2.912 trillion NFD expansion. At 59.304 trillion, non-financial debt surged to a record 304% of GDP. NFD to GDP ended in 1999 at 184%, 2007 at 227%, and 2019 at 250%. This is off the charts, as they say. Unprecedented deficit spending saw Treasury securities jump 2.852 trillion during the quarter to a record 22.371 trillion. Treasuries were up 3.352 trillion for the first half. Over the past year, Treasuries jumped 4.55 trillion, or 25.6%. This dwarfs the previous annual record, that's 2010's 1.65 trillion. After ending 2007 at 6.051 trillion, outstanding Treasury securities ballooned 16.32 trillion, or 270%. Treasuries ended Q2 at 115% of GDP. This is up from 44% to end the 90s, 41% to conclude 2007, and 69% to close out 2010. Agency securities, which are bonds issued by government-sponsored enterprises such as Federal Home Loan Bank, declined 25 billion during Q2 to 9.746 trillion. Agency securities were up 481 billion over the past year and 786 billion for 2 years. Having increased an incredible 5.037 trillion over the past 4 quarters, combined treasuries and GSE securities ended Q2 at $32.117 trillion, or 165% of GDP. Total debt securities, or corporate bonds and the like, jumped 3.364 trillion during Q2 to a record 51.69 trillion. Over the past year, debt securities jumped 5.959 trillion, more than double 2007's record of 2.669 trillion increase. As a percentage of GDP, debt securities surged 265%. For comparison, debt securities ended 2007 at 200% of GDP, the 90s at 157%, the 80s at 126%, and the 70s at 74%. Total equities surged 9.121 trillion during the quarter to $51.956 trillion, with a one-year increase of 884 billion. That's 1.7%. Equities as a percentage of GDP rose to a record 267%. This compares to cycle peaks 181% at the end of Q3 2007 and 202% to conclude Q1 of 2000. Total debt and equity securities increased to an unprecedented 2.485 trillion during Q2 to a record $103.64 trillion. This growth more than doubled Q1's 2019 record to a 5.97 trillion gain. For comparison, Q4 in 2009, 3.449 trillion gain was the largest quarterly increase prior to 2019. Total securities ended Q2 at a record 532% of GDP, compared to cycle peaks 379% during Q3 2007 and 359% to end Q1 in 2000. Total securities ended the 80s at 194% and the 70s at 117. Just to cap on that again, we're at 532% of GDP for that one. The household balance sheet, as we discussed last week, always offers fruitful bubble analysis. Unprecedented growth in the Fed's balance sheet, debt and securities translated into record household perceived wealth. Household assets jumped $7.637 trillion during Q2 to a record $135.435 trillion. And with liabilities only increasing about 29 million, household net worth inflated a quarterly record $7.607 trillion to an all-time high of $118.955 trillion. Net worth was up $5 trillion over the past year. Net worth ended the quarter at a record 610% of GDP. This compared to a previous cycle peaks of 492%, Q1 in 2007, and 446% in Q1 in 2000. Federal Reserve assets jumped 1.185 trillion or 19.2% during the quarter to a record 7.364 trillion. This pushed first half growth to 2.985 trillion or 68.2%. This compares to the 729 billion increase during Q4 2008 and 2008's 1.32 trillion second half expansion. The Fed's balance sheet ballooned 3.35 trillion over the past year, or 83.7%. Fed assets ended 2008 at 2.271 trillion, having ballooned from year-end 2007's 981 billion. Fed assets ended 1991 at 697 billion after a 107 billion Q4 gain. The 80s at 315 billion, the 70s at 167 billion, and the 60s at 81 billion. Fed assets averaged 6.4% of GDP during the three-decade period of the 70s through the 90s. This ratio jumped to 15% in 2008 and rose as high as 28% during Q1 in 2015 and ended Q2 at 38%. Unprecedented stimulus and market intervention from the Federal Reserve and global central bank community unleashed epic market speculation in the face of rapidly deteriorating fundamental prospects. There are indications this speculative cycle has commenced the process of succumbing to reality. Risk off is gathering momentum across global markets. While Friday's rally cut US equities declines for the week, painful losses were suffered elsewhere. Major equity indices were down 5% in France, 4.9% in Germany, 4.4% in Spain, and 4.2% in Italy. Hong Kong's Hang Seng Index sank 5%, with China's CSE 300 Index down 3.5%. Real estate jitters rekindled China's housing bubble anxiety. Emerging markets were under significant pressure. South Korea's Kospi Index sank 5.5%, with India's Sensex down 3.8%. Taiwan's TWSE Index fell 5%. In EM currencies, the Mexican peso lost 5.4%, the South African rand 4.7%, the Colombian peso 3.9%, the Polish zloty 3.6%, the Russian ruble 3.2%, the Brazilian real 3.1%, the Chilean peso 3%, and the Hungarian forint 2.6%. 10-year dollar yields surged 25 BPS in Brazil, 25 BPS in Ukraine, 12 BPS in Indonesia, and 8 BPS in Philippines. Global risk off squeezed the US dollar bears as the dollar index rallied 1.8% to two-month high. The dollar rally hit commodities markets, with gold dropping 4.6%, silver 14.9%, copper 4.7%, and platinum 8.8%. The industrial metals were all under pressure. Global bank stocks were under heavy selling pressure. European banks were hit 7.8%, closing Friday near March lows. Hong Kong's China H Financials Index fell 5.8% to lows since March. US banks sank 6.8%, trading near 4-month lows. Bank debt credit swap, or CDS's, prices jumped to near 3-month highs. Risk off is making some headway in US credit. At $4.86 billion, high-yield bonds suffered their greatest or largest outflows since March. High-yield CDS prices jumped about 50 BPS this week to a 1-month high of 400 BPS. A natural gas company proposed its junk bond sale. Investment-grade CDS rose a notable 13 BPS this week to a 4-month high of 74 BPS. For newer subscribers to our news, you may have missed Dalio, one of the world's largest hedge fund. Outline why we now be in one of the final throes of this epic long-term debt cycle. Figures like those we've just talked about reinforce that we're in the death throes thesis. Take a second to digest the numbers we've just talked about and listen to your gut. Dalio famously said, if you don't own gold, you neither know history nor economics. They're massive figures that we've released today. And again, seeing those negative prints in GDP last night make news particularly interesting at the moment. Well, thanks for listening again. You can always go to ainsleyBullion.com.au for all things gold and silver, ainsleywealth.com.au for all things cryptocurrency, buy, sell and exchange, or goldsilverstandard.com to check out our gold and silver backed cryptocurrency. We'll catch you tomorrow.